Hello and welcome to the new improved Portfolio Matters weekly markets checklist. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, Keith, what do we have this week?
Well, first of all, some housekeeping. Thank you to everyone who suggested improvements to the podcast. We're going to run with it this week. Hopefully, we have got rid of some of the duplication and it should be shorter. Please give us your feedback. And thank you to Rogue Trader for his contribution to the Discord chat this week, which went very well, I thought. And we're doing another one next month. Okay, news this week. Well, the big news was US inflation, which came in soft. It came in at 3.0% year on year in June, down from 4% in May. Core CPI also fell. Equities, everything has rallied this week as it looks like we can see the end of inflation in the US in sight. In the US, the banking regulator has proposed that banks with more than 100 billion in assets hold higher levels of capital to prevent further failures such as that of Silicon Valley Bank, which we covered earlier in the year. And if that goes through, then the banking industry has warned that that will limit credit availability. We have the usual section on the credit crunch coming up. UK Chancellor Jeremy Hunt has ordered departments to find 2 billion of savings in order to fund public sector pay rises. And that's good news because he is attempting to limit fiscal spending. And finally, the Bank of England has done stress tests on all the UK major banks. And this shows that they can survive a severe macroeconomic shock without needing more capital. Some charts relating to the news. So these are US rate expectations pre and post the CPI report. And the white line is post CPI, and you can see they have come down. So the markets don't believe that the Fed will need to raise rates either as high as they had previously, and they think that rates will come down faster now. And a side effect of that has been the US dollar has sold off in really sharp fashion this week. We will take you through the data. And that's been very good for any asset that is denominated in US dollars, such as precious metals. But, of course, if you hold it in sterling, you haven't really seen much of a change. And despite the weak CPI number, the markets are still pricing in a 92.4% chance that the Fed raises at its meeting on the 26th. Okay, on to this week's economic data. Now, the feedback we got from you was that we were duplicating in having a table and then going through the charts. So now you'll see we're presenting both the data and the chart in one go. Okay, so starting off with British Retail Consortium retail sales for June, missed expectations, but still a decent number at 4.2% year on year, partly driven by the good weather. UK Royal Institute of Chartered Surveyors house price balance was really bad, expected at minus 34, down from minus 30 in May. It came in at minus 46. So majority of chartered surveyors seeing house price falls in the UK. Industrial production for May was very poor, expected at minus 0.4, came in at minus 0.6, down on April. So UK manufacturing is not doing well. And year on year, it was down 2.3%. And that is worse than April, but met expectations. UK GDP for May was better than expectations, but still down 0.1%, affected by the bank holiday. And year on year, UK economy is contracting, down 0.4%, although that did beat expectations. Construction output fell sharply to plus 0.2% year on year in May. That's a substantial fall from April when it was 2.7% year on year, and that missed expectations. So the UK construction sector is slowing. Now, in the Discord chat this week, Rogue Trader was talking about the UK house builder Persimmon, and Persimmon have reduced the number of houses they are building in the UK by 42% this year. So higher interest rates are cutting construction spending. And the balance of trade, worse than expected. In May, our balance of trade was minus 6.6 billion, much worse than expected and much worse than April. And the April number was revised down to 2.5 billion from its previously reported 1.5 billion. The UK unemployment rate ticked up. It was expected to be flat, and actually it increased substantially to 4%, which is good news, more slack in the labour market. And the employment change in April was 102,000, well down on March and lower than expectation. So I think you're beginning to see a developing pattern of weakness in the UK jobs market. Unfortunately, earnings continue to surprise the upside. So in May, consensus was that UK earnings would be 6.8%. They came in hot at 6.9%. And the April number was revised up to 6.7% from previously reported 6.5%. So that is really not good. The UK still has persistent wage pressures, and excluding the bonuses, again, beat expectations, coming in at 7.3%. And previously, I have talked about how the national minimum wage, which rose by 9.7% in April, has been a big contributor to the wage inflation we're experiencing. Now, the Low Pay Commission estimate that there are only around 1.6 million workers at or below the national minimum wage, and that's only around 5% of workers. So as Spider786 on the Discord points out, that's not a huge proportion of the labor market. However, that will also influence the wage negotiations of other low-paid workers near the minimum wage. Now, talking further about UK in jobs market, in June, the claimant count, i.e. the number of people signing on for unemployment benefit, was expected to fall by 22,000. It actually rose by 26,000. And so, again, further evidence that the UK labour market is slowing. And in June, we had a 9,000 fall in HMRC employment. So, number of people in work and paying tax has fallen by 9,000 in June. And the part of the good news behind the rise in unemployment was that it's being caused by people coming back into work. If you look at the right-hand chart, which is economic inactivity, you'll see it's fallen sharply in the last few months. And that has been driven by people who had been looking after family coming back into the labour force, but also long-term sicks fell by 30,000 over the last quarter. And retired people are coming back into work. So more people are entering the labour force. That's good for UK inflation and reduces the pressures to raise wages, hopefully. Richard.
Thank you, Keith. So the EU ZEW Economic Optimism Index is better than expectations, but nevertheless still down minus 12.2 from minus 10, which means the EU is continuing to show signs of slowing. EU industrial production month on month down on April at 0.2%, and worse than expectations. The expectation wasn't particularly high, but it's worse than expectations, and suggests that the EU industrial base is contracting slightly. Well, rather, the rate of growth is very low indeed. And EU industrial production year on year is significantly down on April and significantly worse than expectations. So it looks like industrial production in the EU is suffering with the tightening of economic conditions there. So US CPI year on year, as we've all read in the papers and everything, is significantly down. Consensus expectation 3.1, actually 3, and continuing to fall sharply. They're not far off the nirvana of 2%, interestingly. Yeah. And what's noticeable is that US inflation is behaving very differently to inflation elsewhere in the world. So you have US CPI month on month, which was up a little bit, but not as high, not as big an increase as consensus expectations, but clearly it is low in comparison to what it has been, say, January 2023. Now, US core CPI is also down on both May and on expectations, showing this continuing reduction in the rate of inflation in the US. And every month this data goes by, it seems to cement the idea that US inflation is under control and falling. So you have US core CPI month on month, which is also better than expectation and better than May. And that number has been fairly sticky. It's around about 0.4% for quite a while, and has suddenly dropped to 0.2%. And US PPI is almost negative, or almost zero. And the question is it going to fall into negative territory? At the rate that it's going, I wouldn't be surprised. And it significantly beat consensus expectations. So inflation is now surprising on the downside, or PPI is surprising on the downside. And there's US PPI month on month, which is at a very low level. And US core PPI year on year approaching 2%, better than expectations and down on May.
Yeah, and the May number was revised down from 2.8 to 2.6%.
And there's the US core PPI month on month, 0.1%, which is like annualized 1.6%, I'm just guessing there. US car prices month on month dropping very fast.
Yeah. I should say we don't have any consensus expectations for this number.
And US used car prices year on year. I mean, they seem to have recovered. They're reversing the COVID surge that we saw. And they've got a way to go yet, actually, before they reverse that COVID surge.
Yeah. So as supply chains have normalized, so more cars will come onto the market, those extraordinary price rises are unwinding.
And the Mannheim Used Vehicle Index, which shows that big COVID peak, is showing sort of starting to show a fairly consistent downtrend, I think.
Yeah, on your point, Richard, I think there's a long way to go before they get back to what are reasonable levels.
Yeah, I think they've got a long. I think that's right, Keith. So we're going to we would expect to see this decline continuing for a number of months. We have US inflation expectations, which have dropped really quite dramatically since the peak, and continuing to fall fast. And also,
yeah, but I mean, the US consumer is still expecting 3.8% inflation in a 1-year view, which the Fed will think is too high.
That's true, Keith. Yeah. The National Federation of Independent Businesses,
yes,
is optimism index has crept up a little bit. Still below 100. It seems to spend a lot of its time below 100. But is it basing is the question. And the US IBD TIPP economic optimism index, which I have to confess, Keith, is new to me.
Well, actually, but we have covered this. We cover this every month, Richard. But it's a survey of 900 US consumers. So how accurate or representative that is? 900 just doesn't seem actually that much to me.
No, it doesn't, and it depends where they're all based as well, doesn't it? US being such a large country. So anyway, it's down on previous month. It's worse than expectation, and I guess, you know, if you just try and take a trend, the trend is down.
Yeah.
And the US Red Book retail sales is just tipped below negative for the first time in quite a while, suggesting there is some economic slowdown going on in retail.
Yeah. Now, the Red Book retail sales is same store year-on-year nominal comparison. So that excludes any inflation effects. So this is, you know, quite an important fall. And we have been covering this week on week, and it has been looked like it was going to go negative. Now it has. So the US consumer doesn't appear to be doing very well.
US initial jobless claims basically still having had that sort of jump up in early on in this year. Fairly stable now, not showing any particular movement. And US continuing jobless claims are continuing a very gentle decline. So from that point of view, the Fed will be thinking the job isn't done yet. US MBA 30-year mortgage rate creeping back up to 7%, suggesting further pressure on the housing market. And the US MBA mortgage market index now down, stabilized at around about 200. So China inflation numbers, China really seems to be having very low inflation. It's not suffering the same inflationary impulse that the US and Europe and other developed countries have suffered. It does appear to be going through a significant slowdown, which I'm sure we'll come on to shortly, but basically there isn't any inflation in China.
Yeah. Okay, so in summary, in the UK, retail sales were surprisingly strong in June, indicating that UK consumers still have money to spend. Wage growth, unfortunately, came in hot yet again at 6.9%, including bonuses in May. But I think we are approaching a peak. I fully expect inflation to start coming down in the UK in the coming months in the same way that it's come down in the US, but with a lag. Industrial output was down 0.6% in May, and certainly the UK manufacturing sector, like all the manufacturing sectors around the world, is struggling. But we've also seen this week that the UK labour market is slowing. We had a rise in the claimant count in June, and HMRC payrolls fell for the first time this cycle. Unemployment also rose. So it does seem as though we are starting to get some slack in the labour market. In the US, CPI numbers showed declining inflationary pressures everywhere, as we have been saying repeatedly on this show over the last few months. The Johnson Red Book retail sales show that retail sales are falling in nominal terms despite strong inflation. And we've had US optimism, which declined slightly, but the bottom line is there's been no uptick in the jobless claims. So the US economy seems to be doing just fine at the moment, although we believe it will be slowing in the coming months, of which more later. In the EU, we've had economic confidence and industrial production numbers, both of which declined in June. The ECB still raising rates. The EU economy is slowing towards a recession. And finally, in China, China is close to deflation. There's a fundamental lack of demand because its economic model is based on investment, not consumer consumption. And I was listening to a podcast this week warning that the Chinese economy, which has enormous amounts of debt, is in danger of a lost decade, a la Japan.
Moving on to US CPI. So the New York Fed underlying inflation gauge fell to 3.5 year on year from 4.0. And you can see that every measure of inflation here is falling fast. And this is showing the major contributors to the rise and fall. And you can see that energy commodities are one of the major contributors. The big price rises of a year ago falling out of the equation. But you can also see that shelter is contribution to shelter is quite positive, and food inflation is still very evident. So a bit of a mixed bag there, but obviously the energy commodity is very, very significant.
Yeah, but those are all, the light blue lines are all year on year. And if you look at the dark blue bars, then month on month, there's really not much, you know.
Yeah, very true, Keith. I mean, I think the interesting thing is, why is it that US inflation is so different to everywhere else? So the owner's equivalent rent is remaining a strong contributor to core CPI, but we do expect that to fade. As we said, the way it's calculated, it's a significantly lagging indicator.
Yeah.
So has that dropped back?
So just to come back to you on why I think that US inflation is different from in Europe and the UK, in that I think the initial price shock was lower because they didn't have this problem with natural gas, which Europe had. And so, you didn't have this enormous rise in household energy bills. And so because they had lower energy shocks, then they had lower second round effects. So then people didn't demand, huge wage rises to compensate them for this big increase in inflation, which is what you're seeing in the UK. But importantly, in the US, they've had decent immigration. And so in the UK, for example, we've lost people due to retirement, early retirement, and long-term sickness. And we haven't replaced those workers with net immigration. In the US, they have. And so,
although the latest, I'm not disagreeing with you at all, Keith, but the latest immigration figures into the UK for net migration inwards was something like 700,000.
Yeah.
So are they not joining the workforce?
No, that's true, but quite a lot of those were students from memory. But you're right, there has been net immigration into the UK.
Yeah, it is. It's a conundrum, really. So this is showing the effect of the lagging effect of owner's equivalent rent. And so if you substitute real-time shelter prices instead of OER, then CPI drops to effectively zero. Which sort of rather begs the question: why does the Fed use OER? Because it's such a bizarre number to use. It's like driving using the rearview mirror. When you don't have.
Well, it was done in the 1970s, and they've just stuck with it. I mean,
yeah, very silly. So US core services at shelter now at 2.1%, having fallen from nearly not more than 9% a year ago.
Yeah, and this is something the Fed looks at. This is one of their core metrics, and that's getting pretty close to target, frankly.
Yeah. And core sticky inflation from the Atlanta Fed is still at 3.5%, but as you can see, it's falling fast. And on a year-on-year basis, all CPI components are falling, some more than others. Services is falling pretty slowly.
Yeah, but a part of that's shelter.
Yeah. Inflation fell even though there was a rise in fuel prices in June, and we have seen oil price tick up a bit over the last few weeks. So basically, all the data is showing a reduction in the inflation rate, a sharp reduction in the US inflation rate. So the side note here is inflation is volatile, and this is the chart from back in July 2022, where the Bloomberg economic model was forecasting the zero probability that inflation will fall below 4% in 2023. And we have now inflation significantly below 4%. So these forecasts are really very difficult to make, both on the upside and on the downside.
Yeah, absolutely.
So our summary is US inflation is coming down. It's coming down quite fast, and actually there are no outlying indicators. The labour market is remaining tight, and wage inflation is too high to be consistent with the Fed's 2% target, which presumably is why they are continuing to be bullish on interest rates, and the market is still expecting the Fed to raise by a further 25 basis points in July. If these inflation numbers are correct, that would be the last rise, I think.
I agree with you. And just on Richard's point earlier about inflation, I think the inflation was caused by extraordinary pandemic and fiscal stimulus creating strong demand, while the post-pandemic workforce shrank due to retirement and sickness, causing a lack of labor supply. Now, in the US, inflation has come down faster than UK because of immigration and the fact the initial shock was smaller. The UK has a bigger problem because, frankly, we've got a bigger problem with long-term sickness, lower levels of immigration, and the fact we have these concentrated industries such as the NHS, where they have significant labor pricing power. But in the long term, well, in the coming quarters, I expect the UK economy to slow and UK inflation to slow, just as it has in the US. Okay, thank you, Richard. On to one chart. And this is interesting. This is the European Association for the Cooperation of Transmission Systems. So it's the European grid. And it is the number of frequency deviations on the European grid. So what happens is, as you try and integrate more renewables, which are highly intermittent, so wind blows and then it stops blowing and you get a sudden drop in power, then that affects the voltage and the frequency of the power in Europe. And if the frequency drops below a certain point, then you get an outage. And what you see is these frequency incidents are steadily rising. This chart starts in 2015, ends in 2021. And that is coincident with the steady rise in wind and solar, which as of now are more important to the grid than fossil fuels. So we are continuing to add intermittent renewable power sources, and that is going to cause problems for the grid, integrating them into the grid, and could well cause electricity supply disruptions in the future. Richard, any thoughts?
Yeah, it's interesting, Keith. So obviously the grid operates on the AC grid operates on 50 hertz, 50 cycles a second. I'm guessing what this is saying is that when you start to integrate lots of renewables, that becomes quite unstable, and then apparatus equipment will have a certain tolerance. But if that tolerance to maybe drop to, I'm making this number up, to 48 cycles a second, if that's where its tolerance is, if the frequency of the grid drops 47 cycles a second, they have to cut the grid, otherwise it causes damage to the equipment, or the equipment just fails. So, which means that renewables have two issues, don't they? One is they are intermittent. Two is if you have too many of them, the grid becomes unstable. So in fact, they have two downsides, which are actually on opposite sides of the equation. One is they don't generate. The other one is if they do generate, the grid becomes unstable.
Yeah.
And basically, we need a chunk of nuclear baseload.
Yes, that's where I was going as well. Onto US commercial real estate. Now, I listened to a really interesting podcast during the week, and given by a professor at Columbia University. And this chart shows the average occupancy rate for US offices in 10 metropolitan statistical areas. So, you know, big US cities. And the fall has been absolutely astonishing. So if you started at 100 back in 2020, pre-pandemic, then it's collapsed about 50%. And the knock-on effect of that is that rents have fallen sharply and keep on falling, because if you think about it, there are now twice as many buildings as potential occupiers. So as leases come up for renewal, all the buildings are competing on price for the remaining occupants. And so you're seeing this steady fall in revenue. And you look at the right hand chart, total square footage of leases signed annually. Look at that. Absolutely shocking declines. And special servicing rates in the US refer to mortgages that are more than 2 months behind on their payments. And so what you're seeing is that developers who have taken out big mortgages to build big office blocks are now falling behind on their mortgage payments. And you're looking at the red line here, that's office. And you'll see that that has doubled in the past year, and it's accelerated in the last 6 months. And he was talking about the urban doom loop. So people and businesses leave cities because, in part, the rise in remote working means they don't need to be there anymore. That means urban tax revenues fall, and that means the city budget falls, leading to urban decay and higher crime rates. In order to counteract that, the municipality attempts to raise taxes, and that causes more people to leave the city for lower tax environments. And so you get this doom loop. And he was saying he thinks it's only just starting in the US. And this is the iShares mortgage-backed security ETF. And you see that it's fallen a long way and it's not recovering. So the bottom line is that the US has a big problem with mortgage-backed securities, particularly for offices. And most of those losses are yet to be taken. The small banks have extended a lot of credit to commercial real estate. And we've talked about this before, but the banking crisis in the US is not over. It's just ticking away in the background.
And interestingly, Keith, this isn't particularly caused by interest rates. I mean, interest rates will have an effect and aggravate it, but this is caused by a change in society.
Yeah.
So moving on to credit crisis watch. This is the S&P Regional Bank ETF, which remains really weak. Bank deposits to the 7th of July dropped by 1 trillion in 2023. So that obviously significantly affects the liquidity of US domestic banks. US bank credit fell by 23 billion last week. So interestingly, this line, the bank credit sort of oscillates around slightly above zero most of the time. In 2000, so around about the time of the GFC, it oscillated below this zero line. But if you look now, it's starting to get quite volatile, below and potentially below the line in a way that it hasn't really done ever before if you ignore COVID. And clearly, if US bank credit is falling, it's because banks are not able to advance the credit. And we have the same thing here with loans and leases, and very similar effect happening on the chart. And a significant drop in US bank credit in the current year, calendar year. So we've got negative bank credit growth, and this is all signifying slowdown in lending, which will follow through into a slowdown in economic growth, but also a tightening of credit conditions, presumably, as we've looked at previously, which will make lending more expensive, borrowing more expensive for businesses, and gets into that sort of vicious cycle of debt becoming more expensive, refinancing becoming more expensive, and businesses struggling to pay to service their debt. And this is a chart which shows commercial real estate debt, and 1.4 trillion of commercial real estate debt is coming through in the next few years. Much of it is held by banks, and basically what that means is it all has to be refinanced, and it's going to have to be refinanced at a much higher rate of interest. And we've seen what's happened to the commercial real estate market in terms of rental demand. And if this then comes along and hits the commercial real estate market as well, it will be a very powerful hit to that market. What's FHLB?
So that's the Federal Home Loan Bureau. So Federal Home Loan Bank. And so this is basically the most expensive form of funding that banks can get.
And it's shooting up, suggesting that banks are desperate for FHLB funding.
Yeah. Well, thank you very much to Wayne J for these charts.
And we see here money has been continuing to leave the banking system for money market funds. And there's that big, that large spike up over the last few months, which we know about. And this is showing that people are able to get a much higher rate of return now in money market funds than they can in the banking system. And you see here money moving from smaller banks into brokered deposits. Again, bad news for these smaller banks who are really being squeezed. And this shows the spread between the corporate rate, the BAA corporate rate, and the 3-month Treasury rate, which in the beginning of 2022 was 3.5%, and now the spread is about 0.5%, which means that the corporate rate has not kept up by any means with the increase in the 3-month Treasury rate, which is why the banking system is being so badly squeezed.
Yeah. And when the banks take money from the FHLB, that is linked to overnight interest rates, which are going to be close to the Treasury rate. So, they've just got no margin. They're not going to be lending.
Total loan growth has collapsed from 12% last year to 3.4% in July. And commercial industrial loan growth is now negative, meaning that principal is being paid back faster than new loans are being issued. And real estate loan growth has halved, more than halved. So there's a real reduction in debt issuance in the US, which will inevitably have a significant effect on GDP and economic growth, but also these property markets. So the US leveraged loan default rate is going up quite rapidly. It's not yet hit that sort of 2% threshold, but it is advancing very fast. And clearly, I have to keep one's eye on whether that doesn't continue. If it continues at that rate, then that's yet more pressure on the banks.
Yeah, I think that's going through the roof. As basically, that is just the lag effect from companies having to refinance these loans. Leveraged loans refers to lending to highly indebted corporations.
And of course, those loans have been made at very low rates of interest to have to refinance at a much higher rate of interest, which means effectively they become unaffordable. It's too dangerous for banks. They don't refinance, and the loan becomes delinquent. Credit card delinquencies at small banks have now reached an all-time high of 7.2%, which suggests there's a segment of the US population is really struggling.
Yeah, 7.2% is a really high number. It's very difficult to think of an interest rate that's going to properly compensate you for that. Because, if you're talking about 50, let's say 15%, 20% interest rates, well, when you account for the fact that actually 7% of your borrowers are just not repaying you, then your actual net interest rate is much, much lower.
Yeah, indeed. And credit conditions for US small businesses are tighter than in the past 2 years, but haven't yet hit recessionary territory. And we just have to wait and see.
Yeah, I think we wait. I think they will.
So what do we say really? Banks have little incentive to loan, and bank loan growth or absence of is proving that point. So we've got tight US credit conditions, rising defaults, and we have the negative credit impulse, which will create economic headwinds. And what we've been saying all along, it's taken a little bit longer than we thought, but we are starting to see significant impact now on the US credit market.
Thank you, Richard. And on to Inflation Watch. So this week we've had inflation numbers for the US, which came in better than expected. Okay, so looking at US consumer inflation expectations, well, the good news is they are coming down fast, but they still remain a bit too high for the Fed's comfort on a 1-year view. On a 3-year view, they're still hovering around 3%. But if you break down their expectations, then essentially they're expecting food and energy bills to come back down to about 5% per annum, but it's the services and rent they're worried about. Now, turning to the EU, there is a huge divergence between consumers' expectations for interest rates, which is the green line, and inflation, which is the black line. Consumers in Europe now think inflation is not a problem, but they're worried about continued interest rate rises. So the fundamental problem for the US economy has been a tight labor market causing inflation, as it has everywhere, and lots of workers age 55 plus have left the labor force. And so you see the orange line is participation amongst workers aged 55 years and older, and the blue line is 25 to 54. And so in the main workforce, 25 to 54, we have actually record participation. So the US economy is running out of able workers. And when you look at what the drivers of inflation are now, then back in 2020 and 2022, you could see that goods and energy inflation were big drivers of inflation. Now it's mainly wages, and actually corporate margins are contributing to a fall in inflation. It implies that corporate profit margins are being squeezed. During the pandemic, what happened was that there was a big increase in consumer demand as consumers had money to spend due to fiscal largesse. And frankly, they couldn't leave the house. So they couldn't spend it on services. So they started buying goods. And manufacturers found themselves with strong demand and low levels of inventory. So they raised prices. And that increased their margins. But now they have the opposite is occurring. So they are reducing their margins. And that is good for goods inflation. Now, we're turning to the tight labor market. We know that according to the JOLTS jobs report, there are many more job openings than there are unemployed people. Now, even if you assume that job openings are overstated by 25%, then, and that's the dashed green line, it's still a tight labor market. So even if you get rid of 25% of the job openings, there are still too many jobs openings for workers. So the US labor market remains very tight, and that's why the Fed is going to be raising interest rates in July, as the market expects. And the good news, more good news, is that when you look at PCE inflation, the cyclical component is starting to turn down. Now, when we talk about the lags in monetary policy, the acyclical component, which you can consider as being independent of monetary policy, has been responsible for the reduction in PCE inflation so far. Only now, in the last couple of months, is our cyclical components starting to fall. And monetary policy acts with a long lag. Everywhere, wages respond to historic inflation with a lag. So workers see what inflation has been. They demand higher wages to compensate them for the historic numbers. And then it takes a few months for those new demands to be negotiated. You'll see, so the orange line is 1 year inflation expectations. The black line is the wage tracker. So it lags the rise in inflation expectations, both up and down. And this are the latest numbers. It's just come down to 5.6%. And as inflation expectations are coming down, so you'd expect wage demands to also come down. Now, if we look at the Eurozone, the same effect is happening. You'd expect wages in Europe to also start coming down. And even in the UK, that will start coming down. Turning now to rents in the US, well, the vacancy rate is the highest in 5 years. So you expect rental prices in the US also to start dropping. And you can expect to see not only disinflation, but actually possibly deflation in rents. And I was surprised by this. US airfares actually fell sharply in June, despite the fact that, travel demand has been really strong. So everywhere you're seeing falls in inflation, and online good prices are back in deflation. But having said all that, the comparators for year-on-year CPI now start to get worse. And so if you have 0.1% CPI starting from July, then you'd still end up with 3.2% inflation at the end of this year. If it's 0.2% a month, you end up at 4%. So inflation actually is likely to bottom in July and then start rising again. And talking about food inflation, the green line is the price expectations of German food manufacturers. And you see they've gone negative. And the black line is German food inflation, which remains strong, but should follow manufacturers' intentions lower over the coming months. And you would hope UK and European food prices would follow similar patterns. So expect to see rapidly falling food price inflation throughout Europe in the coming months, hopefully. And the UN Food and Agricultural Organization Food Price Index continues to fall. But you may have seen this, climate change is causing a lot of volatility to particular food items. And this is the price of Spanish olive oil, which has gone through the roof because of the drought. So in some way, inflation has peaked. Even in the UK, inflation is in the process of peaking, and expect to see it actually come down quite sharply in the coming months. And on to recession watch, Richard.
Thank you, Keith. That's very interesting about inflation peaking. It's easy to get caught up in the moment with inflation, isn't it?
Yeah. So we talk all the time about GDP, and reminder that GDP is, an estimate, and it's an estimate of economic activity, and you can estimate economic activity another way by measuring incomes. So rather than measuring spending, measure incomes to companies and individuals, and GDI does that, gross domestic income. And reminder that in Q1, GDI actually fell negative. So although GDP in the US has been quite strong in Q1, and the Atlanta forecast for Q2 is, again, it'll be around 2%. According to GDI, which historically has been a more accurate measure, the US may already be in recession, he says.
It's interesting. So federal tax receipts fell in Q1, and that is normally a sign of there being a recession. Obviously, people are effectively, there is less payroll going out from firms. And permanent job losses are up 19% year on year, i.e. the change in number of permanent job losses has increased by 19% in the last 12 months, which is suggesting that firms are starting to lay people off, although the unemployment numbers don't show that. And Fidelity is estimating that the EU and UK economies are in recession. They're also showing that India, Mexico, and Japan, US, Australia, Korea, and Brazil are following that path downwards, but are not there yet.
Yeah.
In fact, looking at their chart, the Eurozone might be pulling out of recession fairly soon.
No, that's misleading, Richard. The green is the Eurozone. Red is China, which reappears on the right left-hand side.
Yes, that is very misleading, Keith.
Yeah. No, I was caught out there for a second as well.
Private sector debt service costs are rising everywhere, and particularly in the US and UK. We've discussed that a little bit earlier, and if you look at the graph of France, then that is actually the highest of all. So we've got rising and problematic there. But
yeah, I found this really interesting because the ECB has to set one monetary policy for all the countries in the Eurozone, some of which are much more indebted than others and therefore much more sensitive to rises in interest rates. And I hadn't realized just how indebted France is. I mean, when French businesses need to refinance onto these higher rates, that could cause real problems for them.
It could, couldn't it? Yeah. I mean, it's going to cause real problems for everybody. If any business has to refinance, or consumer has to refinance on these higher rates. And it's coming.
Yeah.
Fixed rates have slowed the transmission process down, but when those fixed rates start falling away, it's like the economy is going to hit a brick wall if rates stay high.
Yep.
So if US consumers still have excess savings, which they do, then why are they turning to part-time work to make ends meet? I'll tell you why. They want to keep their excess savings. They're concerned about inflation. They don't want to see the value of their savings eroded.
Yep. Good point.
The Conference Board Employment Trend Index has hit a new low in June. So this is suggesting that non-farm payrolls, which we know is a highly adjusted measure, how long is it before non-farm payrolls start to reflect what appears to be really happening in the US employment market? So the US Beige Book, which provides anecdotal evidence of the condition of the US economy from various surveys, suggests the US economy is slowing, but it is not yet in recession. But we saw a general consumer credit growth slowing to 7.2 billion in May. Again, that suggests the slowing of the economy. Monetary policy is working with a lag. So the full impacts of the sharp rise in interest rates over the past year will be felt in the coming 12 months. And this is obviously for the Fed, but we have the same issue in the UK, possibly a worse issue in the UK actually, because of the domestic mortgage market is not fixed for the term of the mortgage, it's fixed for 2, 3 or 5 years, generally speaking.
Yeah. Now, this is a really important chart, and we'll refer back to it again. But basically, we've got a section coming up talking about why higher interest rates have not caused a recession so far. And the bottom line is that we've increased the lags, we've slowed the monetary transmission mechanism. And that just means that the potential for policy mistakes is vastly greater. And what I think is happening is that because the lags are greater, central banks have had to raise interest rates very sharply, more than they otherwise would. And over the coming quarters, those interest rate rises are going to start biting.
So the OECD's Composite Lending Index.
Leading.
Thank you. So the OECD's Composite Leading Index shows that more economies are beginning to recover, and be interested to know which economies they are.
Yeah, no, I'm absolutely mystified by that. We've had a bit of a bounce in economic activity in the last few months, which is fading. I wonder whether that's it.
Yeah, it's interesting. And China exports continuing to fall is a real problem for the Chinese economy.
Yeah, and actually they're going to start exporting deflation once again, I suspect.
Yeah, of course they've got this massive property debt bubble, and the economy is slowing down. It portends a really unpleasant time for them.
Yeah.
So the world economy is continuing to slow, and interest rates affect the economy with a lag, and quite a significant lag. Interest rates are still rising, and we expect to see increasing effects of the rising interest rates over the next few months.
Okay, so why haven't higher interest rates caused a recession? Which is frankly what I've been forecasting for a long time now, and I've been wrong. Well, first of all, as you can see from these charts, the fundamental problem that caused the inflation to get out of control was that central banks were complacent about the rise in inflation, describing it, you may remember, as transitory, which was idiotic, as we talked about at the time. And we also talked about their manipulation of language, talking about the surge in inflation as transitory, when at best it could have been transient. But the bottom line is, the reason that we haven't had a recession is that we've slowed the transmission mechanism. So in the US, 30-year mortgages have become the norm. And as a result, the rise in interest rates has had little or no effect on debt service payments as percentage of disposable income. And that is the green line. In the UK, we used to have a lot of floating rate mortgages. That used to be the norm back 20 years ago, and now it's not. Now everyone fixes for between 2 and 5 years, with only around 15% on floating. So what this means is both in the US and the UK, mortgage holders are not that affected initially by rises in interest rates. The monetary transmission mechanism by which rises in interest rates affect the economy has been slowed. In the US, it doesn't really affect existing mortgage holders. It affects people who are taking out a mortgage and investment of all other kinds. So Goldman Sachs are estimating that by the end of 2024, the effective interest rate on 1.7 trillion of existing UK mortgages will rise to 4.6% from 2.1% in 2021. So that is going to have a big effect, but with a lag. And that will increase residential mortgage interest payments by 32 billion a quarter. Is that? Must be a quarter. And it will also affect all borrowers, and corporations went on a borrowing binge when interest rates were close to zero, and they locked in long maturities. So once again, initial rises in interest rates won't affect them until they come to refinance their existing debt. And only around 15% of global corporate debt matures before 2025. Now, I read an argument this week that developed market economies are less sensitive to interest rates than they were because they're much more service dominated than manufacturing. So because there's lower demand for capital investment, so rising interest rates don't affect investment as much as they did. But our view is, I don't believe that, because Richard and I are angel investors, and service companies need just as much investment, if not more, than manufacturing. It's just the investment is in people rather than in plant. So, in summary, the fall in the popularity of variable rate mortgages has reduced the speed of monetary transmission, though the effect varies from country to country. And, if you're in the EU, I believe Sweden has pretty much all variable rate mortgages. So the Eurozone, trying to set one interest rate for lots of different countries, that's going to cause real problems there. But the bottom line is the slower speed of transmission means that the lag times are longer. And the problem for central banks is that as they've raised interest rates and it's had no effect, they've kept on raising them. And when you look at the speed of the rise in interest rates, it is very fast by historic standards. And the longer lag times mean that those will start having effect over the coming quarters. They really haven't had much effect so far. We showed you the chart showing the cyclical components of US inflation and how they're only just starting to come down. They will now start to come down quite quickly as interest rates start to bite. And I think with a recession is very likely, certainly in the UK and Europe, but also in the US. And here's why. If you look at the average interest rate in the US multiplied by the size of the US national debt, if all US debts had to be refinanced at current interest rates, it would absolutely kill the economy. The interest bill would be off scale. And I'm going to read this out. This is from Oleg Melentiev of Bank of America. To better appreciate the degree of challenges ahead of us, consider that the Bank of International Settlements tracks total G20 non-financial debt at 250 trillion, double its level since the GFC. Bloomberg's global aggregate yield, the broadest measure of fixed income, is at 4%, up from just under 1% in 2021. In the meantime, the average coupon on this index has only reset by 50 basis points, i.e. most issuers continue to pay the old coupon and are yet to experience the full impact of higher rates. Hypothetically, if all coupons were to reset by plus 320 basis points to match the change in yield, the incremental interest expense of all G20 borrowers would go up by 8 trillion. This is equivalent to the GDP of Japan and Germany combined.
It's not going to happen, is it?
No. So basically, we can't afford it. The higher interest rates will feed through with a lag to much higher borrowing costs for consumers and businesses. And when that happens, then corporate profits come down, investment comes down, we fall into a recession, and you then have to cut interest rates. Now, and this is US private sector debt, and you'll see that since the advent of inflation targeting, it's in the early 80s, it's risen by 50%. So we now have much higher debt burdens on which the interest rates operate. And we were talking about France earlier. You know, France looks like a problem to me. You know, the ECB's setting one interest rate for the whole of the Eurozone with very different debt levels.
Yeah, France is looking more like a problem than the southern peripheral states.
Yeah. And high debt levels make it difficult to sustain positive interest rates for any period. You'll see that when you look at inflation-adjusted interest rates, since 2000, we haven't had positive interest rates for any sustained period of time. In fact, since the GFC, for very few, little periods. And this is the updated chart. So we're not quite there yet, according to this. But with the fall in CPI, we're going to be soon. The Bank of England is forecasting, however, that UK household mortgage costs will not rise to their previous peaks because, as we talked about previously, in part, they are lengthening the duration of their mortgages. Okay, so in summary, the world cannot sustain the current level of interest rates for any long period of time because as existing debts come to be refinanced at these higher levels, so the interest burden would just become unsustainable. And interest rates will need to come down once this inflation surge has passed. And related to that is that we've seen everywhere that employment has held up. Now, this chart we've featured many times, and it shows that employment is the last economic variable to roll over as we enter a recession. And so when you look at non-farm payrolls, as we reported last week, you know, you've had this long streak of increase in US non-farm payrolls, although the rate is declining. But unemployment only starts to rise after a recession has started, and we're not there yet. So when we look at non-farm payrolls, we're expecting the recession to start somewhere around October. And if you think of the June print, which is 209, then, you know, let's see what happens over the coming months. And on to other charts, Richard.
Okay, so this chart shows that the US junk bond market has shrunk by 126 billion from its peak. Right-hand scale is in trillions. And there has been so little net issuance for the last couple of years that funds are cash rich and having to buy back into existing bonds, which supports the price. So although you would expect junk bonds to be under pressure because the junk bond funds have got lots of cash, they are still prepared to buy bond issuance. So I suspect that pressure is going to increase as the US economy does fall into recession, which I think it will, given what the Fed is doing. It hasn't yet.
Yeah. So, I mean, the point is that that's the reason junk bond yields are so low, in these funds are continuing to buy them.
And the US federal fiscal deficit as a percentage of GDP is around about -8% or 8% deficit, which is pretty enormous. And I mean, it was at that sort of level at the time of the Great Financial Crisis, but it does feel as if it's pretty unsustainable. I will comment that it's levels that normally only seen at the bottom of a recession. I mean, I think the world is also changing. We just discussed the problem with interest rates and the fact that devastating impact it's going to have on, amongst other things, government debt servicing. So, I think dependent upon what happens to US interest rates, all bets are off as to where this line goes next.
Yeah. Well, I mean, when you talk about the resilience of the US economy, yeah, this is the answer. This is why the US economy has done so well. You've massively ramped up the deficit, at a time when the economy is doing okay.
Yeah. I mean, I think.
And after all that doom and gloom, you need some good news. And we have a corker this week. Okay. So I found this really amusing. So I'm going to spin this as good news because these days divorce is much easier than it was in medieval Germany, where divorce was settled by combat between man and wife.
Keith, why is the man in a hole?
Well, the rules were the wife was armed with a club or a rock in a sling. The man had to stand with at least one leg in a hold and one arm tied behind his back. And then they would essentially beat each other to death. So if the husband lost, he was beheaded. If the wife lost, she was banished. If the wife killed the husband during the duel, she'd be buried alive.
Pretty much a no-win, wasn't it?
So there you go. Society has become
decadent.
Yes, exactly. Less violent. Divorce is easier. And on to equities, Richard.
So we have the FTSE All-Share Index, which had a good week, up 2.6% for the week, down 0.3% for the year to date. So the stocks Europe was up 2.9% on the week and up 8.5% on the year to date.
This is absolutely amazing, given we know Europe is falling into recession and headed for a deeper recession.
Yeah. Most of that rise was in January. So the S&P 500 up 4% on the week and 17.5% year to date, defying what one would consider to be reasonable expectations. But clearly my reason is different to other people's reason. NASDAQ Composite up 3.6% on the week and 35% year to date.
Yeah. So, I mean, basically the S&P 500, it's all NASDAQ still.
Yeah. So the topics down 0.5% a week, but that too up 18.6% year to date. And the Bitcoin up 3% on the week and up 89% year to date.
Another thing I got completely wrong this year.
Yeah. And pound sterling is, the dollar is weak, so basically the pound and euro against the dollar are up, but the pound against the euro is pretty much unchanged. And there we have the euro up against the dollar as well, basically because people think US interest rates have peaked. And here we have the dollar index falling below 100. And as I think Keith said earlier, it's actually broken a significant technical line. We'll have to see what happens there. But the dollar not looking strong. The VIX muddling along at an extraordinarily low level, down nearly 40% year to date, down 8% on the week. Here we have the fear and greed index. We are on extreme greed, where we seem to have spent a lot of the last 15 years, don't we, Keith?
Yes.
Earnings downgrades are picking up a bit, but it doesn't affect the price earnings ratio of the S&P or the NASDAQ. Not negatively at any rate. And here are the Magnificent Seven for the S&P. For most of them, earnings have fallen in 2023 as their prices have soared. So there's sort of discontinuity, isn't there?
Yeah, I mean, if you look at Tesla, its year-to-date earnings are down 35%. I mean, that's huge drop.
Yeah.
And the P/E ratio has therefore gone up 240% because it's had a 123% return year-to-date. Yeah. It's insane.
And the top 10 stocks in the US are highly rated tech companies. And so as their market cap rises, their earnings contribution falls. But we know that the whole of these indices, US indices, the S&P 500 and NASDAQ, are distorted by these few behemoths.
Yeah.
But their revenue growth has been slowing, which is quite interesting.
Yeah.
And with the Q2 earnings season about to arrive, hopes are concentrated in the consumer discretionary and commercial services sector. And these are the blended EPS estimates by sector year over year, clearly.
Yeah.
Energy, materials, healthcare are the bad boys, and consumer discretionary commercial services are the good guys.
But we know, and we've just covered this, that US consumers are starting to cut back on their credit, and Johnson Redbook retail sales are now negative year on year. So those expectations for consumer discretionaries, are they too high?
So the price earnings growth ratio of the S&P is at a very high level, and normally only seen in the depths of a recession. But we have a return of earnings optimism, and particularly in Europe. So but we haven't actually entered the recession yet. So it's, is the timing a bit off?
Yeah.
And earnings estimates are well ahead of what we're actually seeing.
Well, it's just earnings. Yeah, if you believe these earnings estimates, then corporate earnings would be just way, way above trend historically. Yeah. It's just mystified.
So we got the fact that UK market really has gone nowhere for 20 odd years, and on paper it appears to be the cheapest asset class in the world.
Yeah, relative to its own history.
Yeah.
Not a vote of confidence in the UK, sadly.
It's not, is it?
Okay, on to commodities. Thank you, Richard. And energy commodities. Well, this is Brent, and very good week. So, off to the races for, as interest rate expectations coming down, people are thinking that the US will have a soft landing and energy demand will stay strong. And this is WTI, also had a good week, up 4.5%. So numbers specific to the oil market. Well, despite the fact that oil had a good week, we actually had a big, actually an enormous inventory build in the US, which rose by 17 million barrels. So suggesting that the US market was extremely oversupplied last week. Crude production in the US fell by 100,000 barrels and is only up 300,000 barrels a day since last year. The Baker Hughes rig count was flat. Now, we talk a lot about OPEC and the US, but some of the other non-OPEC members have been doing okay. This is China. Actually, its oil production is surging back towards all-time highs, reducing its dependence on imports. And we look at Argentina. Well, it has actually been successfully exploiting its own shale deposits. These aren't huge numbers in the scheme of global oil supplies, but it is also growing its production. Now, one thing I found interesting was, despite the fall in oil prices, exploration budgets have been rising. And so that is good for oil service companies. And turning now to OPEC Plus, well, actually they have been following through on their production cuts, and production does appear to have been in decline over the last 6 months. And we talked earlier about how how airfares had fallen in June. Well, if you look at commercial jet fuel demand, everyone's flying. It's gone through the roof. Okay, turning now to European natural gas futures. Well, big drop on the week, down 20%, down 65% year to date. Great news for UK consumers. The UK, the same, down 18.5% on the week, down 63% year to date. Fantastic news. US natural gas, pretty flat, but, at its lows. Coal fell again, down 7.8% on the week, down 67% on the year. Uranium ticked down 0.5%, up 13.3% on the year. Still the only energy commodity up. Richard, industrial metals.
Thanks, Keith. So aluminium down 4% year to date, but a big jump this week. And cobalt is down 36% on the year, but unchanged. So maybe it's stabilizing off that dramatic fall early in the year. Copper is again a big jump on the week, up 4.2% and up 3% year to date. Chromium unchanged for a few weeks now, down 10% year to date. And iron ore down nearly 1% on the week, down 4% year to date, but significantly better than the big drop it had earlier on in this year.
But you notice, Richard, that copper and aluminium had big bounces this week.
Yeah.
Iron ore didn't. So, we talk about the weakness of the Chinese construction market.
It's different, isn't it? Because we know a lot of money is being spent in the US in reshoring and developing large factories. Which obviously is going to increase demand for these metals. Hard to know where the balance is. Lithium, very stable at the moment, but 42% down on the year.
Yeah, when we talk about that stability, frankly, it's because the data quality is not very good. This is Chinese lithium, and it's prone to big revisions.
Yeah. And neodymium, had a lot of wind power going on, a lot of electric motors, high-powered permanent magnets, which neodymium is used for, but clearly the supply demand is roughly in balance at the moment. And there's nickel, which is sort of bumping along the bottom of its range. And tin is climbing steadily, actually, since March. Steady uptrend.
Tin is actually a very rare metal in the Earth's crust. And since the EU and other regulatory bodies mandated the removal of lead in solder, they've basically gone to 100% tin, then tin is in demand.
Ferrovanadium, which is down 12% on the year, down 3% on the week, and it is basically going nowhere. And zinc is down 17% on the year, but it's having a little bit of a revival at the moment, along with most of the other industrial metals. And then looking at precious metals, gold up 1.6% on the week, 7% on the year.
Yeah, but the dollar index fell by, I forget, was it 2%? So that's all down to the dollar.
Yeah. And silver up 7% on the week and up 3% on the year. A bit of a squeeze, I suspect, in the silver market, which is always very volatile. Platinum also had a good week generally for precious metals. And even rhodium had a good week. Palladium had a good week, but not as good as the others.
Yeah. Okay, thank you, Richard. On to rates. Okay, so change in how we're going to report rates. Instead of going through all the numbers, I'm just going to show you the yield curves. So the blue line is the yield curve as now, and the green dotted line is as a month ago. Interesting. So we have in the UK had a sharp rise in short-term rates, and you'll notice that the Bank of England has essentially lost control of the yield curve short-term, and that massive increase in rates will feed through to affecting UK borrowers in the coming months. But the market now believes that those very high short-term rates are enough to cool inflation medium term, and over the past month, long-term rates have actually come down. And similar story in the US. So this has actually changed in the last few days, where long-term rates are now unchanged month on month. Short-term rates are still up on where they were a month ago. So despite those very good CPI numbers, rate expectations over the past month have actually increased. So reminder, bond yields start to come down when the Fed pivots, as they come down in advance by up to a month and a half. But then they start to decline. Actually, they should be quite rapidly, depending on the outlook for inflation and the economy. And if we look at interest rates in the very long term, and these interest rates go back to 1350, so obviously there were lots of economists back in 1350 taking these interest rate data, but they've been in a long-term decline. So I expect medium term that trend to reassert itself. Yeah. So the point of this chart is that the market tends to anticipate the change in the Fed funds rate, but overestimate how long it thinks the Fed will keep rates high. Now, the Fed needs to try and maximize the effect of interest rate rises by talking big about how long it will keep those rates high. But as we saw earlier, it can't keep those rates high for any extended period because the interest burden would simply become unsustainable, driving the economy into a hard recession. So at some stage, it needs to bring them down. And this chart shows that historically, the markets assumed that rates would stay high for a long period of time. Actually, when you look at the dark blue line, the Fed has tended to cut rates quite sharply, although, frankly, the pandemic should be ignored. And in the UK, the Bank of England is planning to allow naked short selling of gilts in a bid to increase liquidity and get rid of EU legislation banning naked short selling.
Interesting.
But everywhere, bonds are very cheap compared to equities. You know, we talked last week about how the yield on US bonds is now higher than the earnings yield on equities. So, you know, if the outlook for the US economy is uncertain, and we believe it firmly is, then why on earth would you hold equities for yield?
Yeah.
Okay, so moving on some charts, there's the UK 2-year down a bit from its peak. Good news. 10-year down a bit. 30-year down from its peak. US 10-year also corrected. German 10-year, so generally a decent enough week for bonds. Greek 10-year. So I now think that it's time to move into bonds. Yeah, all of you will know I moved into bonds ages ago, way too early. But actually, I really think that, inflation's peaking, that UK inflation with a lag, and I'm talking about in the next few months, 2 or 3 months, will start to roll over. And then those lagged effects of higher interest rate rises will start to bite in the second half. And I think in the Europe and the UK, recession is absolutely inevitable. And in the case of the US, where we are seeing the student loan repayments start beginning of September and a negative credit impulse, I think we also see a recession. Richard, your thoughts?
I agree. I think in a nutshell, I guess, the current level of interest rates is unsustainable. Central banks have got to play a game whereby they have interest rates. I think they're playing the game that they raise the interest rates very fast to hit the inflationary pressures very hard, to enable them to drop interest rates very fast, which has the effect of not damaging the government fiscal, which has the effect of not really inflicting very much damage on government finances, because the high interest rates are short-lived. I think that's where they're going. I don't see they've got a choice now but to reduce interest rates. And I guess the question is by how much, but I guess the answer to that question is probably by quite a lot. Otherwise, government finances have a real problem. So just coming on to this, I mean, equities, I'm going to pass on equities now because they're just not behaving as, particularly if we're talking US, they're just not behaving as one would expect them to behave. I think bonds probably are a buy. I still think gold is a buy. Industrial commodities, selective, energy commodities, neutral.
Yeah.
I would sort of, my change would be on bonds now, Keith.
Okay, well, I'll update this table for next week, but on equities, Richard, yeah, they have completely defied expectations in the US, not in the UK, in the US and in Europe, which just seems absolutely mystifying given the rise in interest rates. To me, that's, the fact it's defied expectations just is mystifying, and the fundamentals can be ignored for a long time, but eventually they will reassert themselves. And the fact that, to me, the higher it goes up, the harder it's going to fall. So I wouldn't touch them with a barge pole at these levels.
Me neither, but I'm mystified by them.
Okay, on to concluding comments. Well, US inflation has peaked. And actually, wherever you look, US inflation, there doesn't look like there's got a problem. And we have said this for quite a long time now, and the evidence is coming through. That all said, the comparators now start to become quite difficult. And unless you have literally inflation of 0% a month in the US, you will see a bit of a bounce in inflation going into the end of the year. And the Fed still believes that wage inflation is too high and is likely to follow through with the rate rise on the 26th of July, which we believe is probably their last. And I also think that inflation everywhere will come down, including in the UK, in the coming months. But bottom line for me is that although monetary policy has not slowed the economy as much as we've been expecting, that's because the lags have got longer. And that means that the chance, in fact, the inevitability to me of policy mistakes is much greater. So central banks have seen that their interest rate rises have not worked, so they've kept on rising. As you've seen these very rapid rises in interest rates, which will now start to affect the economy. So I think in the coming months, the economies start to slow.
Yeah.
Richard, what have you been up to this week?
My change for the year is 3.2%, slightly ahead of the all share. So my relative performance is 3.5%. So I've definitely fallen back from where I was earlier in the year. No purchases and no sales. Sticking to my guns. This is the VanEck Vector Junior Gold Miners ETF, which I last showed a couple of months ago probably, and it is still in this sort of what a chartist would call a megaphone pattern, well, we will see. But what I would like is for it to break out of the top of that megaphone pattern. Whether it does or not remains to be seen. And the Junior Silver Miners ETF is also in very similar territory. Again, I'd like it to break out of the top. It hasn't done so far, and it's being a bit of a pain to my mind. We discussed this a little bit earlier, but this is actually gold in GBP. And whilst gold had a bit of a run in US dollars, it hasn't had a bit of a run in the pound, and it's a little bit off its high that it put in earlier, right at the end, I think, of last year. And I just thought it'd be useful to see what's going on with the ARC funds. This is innovation ETF. We've had these massive rises in the NASDAQ, but actually, when you look at the ARC innovation relative to where it was, it's still down roughly 65, 70%. But then on the other hand, it's been at this low level for a considerable period of time. The question is, at some point, this would be a buy. The question is when. And that's what I'm sort of just mulling over. Keith is just looking pretty.
Yeah, no, it's up 50% from its lows, Richard.
Yeah.
But I mean,
and this is the ARC Autonomous Technology ETF. Obviously, autonomous technology is particularly what goes into robotic factories and so forth. And that's up 50% from its lows as well. So it's quite interesting. I mean, clearly these are sectors of the economy that are going to grow. The question is at what point. And I suspect, that the NASDAQ is going to come a bit of a cropper at some point. And maybe that would be the time to dribble a little bit of money into these ETFs.
No, I completely agree with you. I think if you look back at the dot-com bubble, what happens is that when there's a proper crash, and I don't think we're there yet, that people lose so much money on these highly speculative technology stocks that they then shun the entire sector, and that's the time to buy. But the lows in the following .com, the lows were literally for a couple of years. Plenty of time. And I just don't think we're anywhere near that yet. Yeah. The valuations have to go a lot lower.
Yeah, very true. How about you, Keith? How was your week?
Thank you, Richard. Well, I had a bit of a disappointing week, actually, in that I was expecting my bond bet to do better than it did, up 1.1%. I was still having a pretty terrible year. But, actually, I really think this is going to pay off in the next few months. And I think that, the UK economy is slow and inflation will come down. And I think that as the economy's slow, because of the lagged effect of these massive interest rate rises, then the economy will fall into recession. At some stage, central banks need to cut interest rates hard. And the way I look at this is that I essentially make big cyclical bets, and I've lost money because the cycle hasn't turned. But I've lost money because I'm out of sync with the cycle. And I think equities are in for a tough time as the economy slows and corporate earnings slow. And so I'm taking my losses now, but I think equity holders are in for losses in the future. So I added a bit to my bet this week. Now, we've been talking about TR24 and mystifyingly how its share price, how its price has been falling despite, and we calculated last week, it's now got an annualized return to maturity in March next year of around 8% based on, RPI. So I sold some And although the price in the market had fallen by 2% since I bought it, because of the indexation, I actually made 1.7%. And I added more to T68. So this is TR24. And, I bought it, back in May at 100, lost 2%, but actually the indexation more than compensated for that.
Mm.
And this is the 2068 gilt, which I've been buying. Reminder, it peaked at 320. So, the moment inflation gets under control, my break even is about 97. I think, honestly, I've got no worries at all about that. Coming back to break even for me. So, it's a question of just waiting for inflation to come under control. And although the Bank of England's been utterly useless about raising interest rates fast enough, the reality is the market has tightened UK interest rates for it, and they're now very tight. Mortgage holders, as we saw earlier, are going to suffer big rises in their interest bills, as is everyone else who invests or has debt in this economy. And we know that this month we've seen rises in the claimant count and falls in HMRC payrolls. I think the UK economy is slowing. Okay, that's it. And we'll end on that cheery note. Well, I hope you liked the new format. Please give us your feedback on the Discord or in the comments section. And next week, I'm in the Lake District and I will be aiming to get something out. But if I don't get it out on Friday, it will be on Sunday when I return to London. So in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.